Happy Dussehra to you and your family, and welcome to this special episode of Gold Rush, powered by Investors Guide. Over the next half hour, we'll tell you everything you want to know about investing in gold. Whether you're putting your money into an ETF or you're planning to buy jewelry during the festive season, this show is going to make your purchase and your investment that much more efficient. Remember, you can write to us. There's an email ID at the bottom of your screen. Send in any question you might have about investing in gold. Now, it makes sense to grab that pen and paper and take down the advice you hear on this show, because on the next half hour, we'll start by talking about the price of gold. Where is it likely to end at the end of the year, and how can you put gold into your portfolio? We'll also tell you how to make sure that your jeweler is giving you the best possible deal on your jewelry and giving you the purest gold. We'll also tell you how you can check. And finally, does silver make the cut as an alternative investment to gold? We'll find out later on the show. Joining us now in the studio to help us answer all of those questions is Naveen Mathur, the Associate Director Commodities at Angel Broking. Naveen, thank you for coming in and thank you for answering our questions. We also have, of course, Dhirendra Kumar, who joins us in our Delhi studio. Dhirendra will answer our questions on our portfolio and, of course, help us fit gold into our portfolios in the long term. Naveen, the obvious question that we have to start with is the price of gold. We saw it go up in the last couple of months to 32,000 rupees per 10 grams. It's come down now. We know it's at about 30,000 rupees or 31,000 rupees. Where do you expect it to go before the end of the year, and is this the time for us to be buying gold?
I think we'll see a range of around 30,500 to 31,300 to 31,400 levels. Between that particular time, the gold prices would be in these kind of ranges. Now, why I'm saying this, there is definitely a festive season where the people would flock. They will not flock the spread they were used to do it earlier, but they will definitely flock towards gold. You won't see much of a demand at these highest prices for the physical gold, but still the demand would come in, and therefore this demand would take the prices on the upside. The only negative factor for gold today is in Indian markets, particularly the appreciation of Indian rupee versus the dollar.
Dhirendra, I know that you've always been a little cautious when it comes to gold. Now, like Naveen was telling us, this is a good time to be buying gold, but would you recommend we go the SIP way when we're buying gold?
My sense is that if you have to buy gold for the fascination of it, or simply for consumption at a future date, and you are scared that you will not be able to lock into the price and over a long period of time it will go up substantially, then by all means, go for a SIP or keep accumulating gold in physical form too. There's a difference between doing by way of SIP. One is that it's very easy and a very small ticket size. A small investment can be made very methodically month after month, and at a future date you can exchange it with real gold, and you'll be insulated from any substantial price appreciation.
When we buy gold in this country, we're not buying it for the next 1 year or 2 years. We're buying it for the next 20 years.
That's right.
So like Maria Suresh, who's written in fact, she tells us that she invested in the GoldX and the UTI Gold ETF a while ago when she was investing for her daughter, and she got it at an average cost of 2,300 per unit. She wants to hold this investment now for 7 to 10 years. And she wants to know how much she can expect it to grow in the next 7 or 10 years. I know this is a tough question, Naveen, trying to but that's the question we are all asking. Where is gold going to be in the next 10 years?
Very difficult to say in the kind of chaos and uncertain world where we are living in. But I feel what I said, 15-18% kind of a CAGR returns we have seen in last decade, I still feel that the gold would be one of the best of the asset classes for a long term if the horizon is to an extent of 17 years or 20 years.
Then still 20% per year, or maybe 15% per year?
No, maybe I'm wrong. Maybe I'll be wrong talking about 20-15%. Maybe I'll be off the mark largely, but I think on the conservative side, all said and done, 5 to 8% returns. Maybe it's pretty low in the kind of environment which you're living in, but it's still 5 to 8%.
So a conservative estimate would be 5 to 8%.
5 or 5 to 7%, 8% kind of returns going forward.
Dhirendra, we know and we've talked about the fact that the ETF is the best way to go if you're making such a long-term investment and you want to. She's investing for her daughter, so she's obviously going to convert this at some point to jewelry. But she has the GoldX and she has the UTI Gold ETF. She wants to know if she should buy one more. Now, we know that most ETFs are identical in the manner in which they function. Does she need 3 different ETFs in the same portfolio?
No, having more ETFs won't help. In fact, you should just have one, and you should have the one which has which you are able to buy closest to its NAV. The one which trades with highest efficiency, and which is Goldman Sachs or UTI. It'll be the top 2-3 based on size.
Remember that what you need to do when you're picking a gold ETF is find the one that has the lowest cost right now, which will be the difference between the price of gold and your unit NAV. And like Dhirendra said, you don't need to have more than one ETF in the portfolio. They're all largely similar. Pick the best one and go with that one. Now, next question comes in from Sushant Hari, who writes in, he already has an existing mutual fund portfolio, Dhirendra. He wants to add a gold fund to it. He wants to know which gold fund would complement his portfolio best. And he wants to know if investing in gold right now makes sense at this point. Now, he has the DSP BlackRock Top 100, HDFC Top 200, Franklin India Prima Plus, UTI Dividend Yield, and Birla Sun Life Frontline Equity Plan A. Now, this sounds a lot like the funds you recommend on the show. If you were to, would you advise him to add a gold fund to that portfolio?
These 5 funds which you have, and you keep making your 5,000 rupee SIP, and don't even consider of dabbling with that, just stay on course with that plan. Have a one-time investment of 50,000 rupee, 1 lakh rupee from the bonus which you get, or some bonanza that comes your way. Create a fund allocation. Playing gold, I think there are very simple. Earlier these avenues were not there. Today you can have it in very plain and simple way. Which one is having a gold ETF. If you don't want to open a demat account, have a gold fund which in turn invests in this gold ETF, and that is 1% more expensive. The third way of doing it is having the gold fund. These are funds. There are 2 funds in India available, which invest in gold mining companies. These and they are effectively a leveraged play on the gold prices.
Quick question for you, Naveen. Rohit has written in. He wants to invest in gold. Would you? He wants to know which is more cost effective, the gold ETF or the e-gold from the National Spot Exchange. Which one would save him more money?
See, both are different and they serve the same purpose. Although the orientation of these are different. See, gold ETFs are running on the equity exchanges like NSE or the BSE. So if he has an equity account, he can definitely well do it and buy gold ETFs. The NSCL product, similar to the same, you buy 1 grams, accumulate it, and maybe after 8 grams, 10 grams, you can have an option to go in for a delivery. So both serve the same purpose. In terms of accumulating gold, unit-wise 1 gram or 2 grams every time, whenever you want to. Now the difference here is that in a gold ETF, you actually do not get a delivery. The beautiful point out of the NSCL is that it is straight away converted into a deliverable bars and coins, and therefore you can have the gold straight away in your hands. Also, what I understand from these exchanges, that they're tying up with some around 10,000 jewelers in the country. Now, if you have this receipt, kind of a warehouse receipt or a demat receipt that you hold so much of gold on the NSCL, you can go to this jeweler, the impaneled jeweler, and exchange that worth the jewelry which you intend to buy.
Cost effective? Which one would be more cost effective?
I think the NSCL product would be much better in terms of cost than the ETFs.